So in today's video, we're going to talk about the top 10 high interest rates loans. And basically, when you have these loans, you feel like you're in chains. So to break out of those chains to freedom, we're going to talk about the 10 high interest rates loans and why the power of refinancing these interest rates loans are still a good idea in the current rate environment. So stay tuned. So what is a refinance? A refinance is when you are redoing a loan by starting a loan all over again and obtaining a new loan based on your current qualification to pay off the existing mortgage that you currently have. So that's why it's refinance, right? If you're financing a loan, then you're buying a home. But refinancing means that you are redoing that loan. We're going to start out by talking about the 10 high rate loans that are out there right now and what people are refinancing and why they're refinancing it. So what is going on with the interest rates right now? The Fed is raising interest rates. So with the Fed's raising interest rates every single month, why are they doing it? Well, they're saying the economy is too strong. So we have really strong job numbers. We have really strong consumer spending. And because of that, we have to taper that down because in the last couple of years, we've lent people a lot of money at really low interest rates. And because of that, we are now seeing the ugly side, I guess, of interest rates because they have to continue to raise interest rates because people are still buying. And hopefully with the interest rates being risen and the values being so high, spending will come down, and to encourage spending again, interest rates will have to start coming down, okay? So these are the 10 most high rate loans out there right now. Number one, auto loans. Auto loans are crazy. I remember getting into the mortgage industry, and when I first got into the mortgage industry, one of the biggest purchases that I purchased was my pickup truck. And I'll never forget, this was in 2005. I was negotiating my payment, and I said, I really want to be at about $280 a month. Well, a 6-year auto loan did that for me. So with that, I was able to secure my brand new truck. And at that point, like I said, a $300 auto payment was pretty high. Now, when I'm pulling credit, more and more interest rates are 8 and above. And more of these payments are getting really close to $800 to even over $1,000 on auto loans. If you have improved credit score, you can try to refinance it, and hopefully your rate will lower as well as your payment. But an auto loan is certainly something that, you know, if it's high enough, would be worth refinancing or potentially looking at maybe even taking out an equity line to pay that off. The second thing is going to be timeshare loans. Timeshare loans are typically going to come with higher interest rates. I recently was on a call with other loan officers, and this loan officer shared with us that, you know, the interest rate on a timeshare loan was around 16%, and the monthly payment was well over $1,500 a month. And that's just for the timeshare loan itself, to buy the timeshare. And that doesn't even have anything to do with the annual maintenance fees or any type of reserves that they may have. So timeshare loans are a great use of refinance funds. Delinquent taxes would be the third thing. Delinquent taxes are typically something that, you know, don't go away, you know, with time. Unless you're willing to tie up your ability to borrow any money for 7 years, I would not go delinquent on tax debt. With the tax debts, when you owe, interest does accrue over periods of time. If you need to negotiate or do some sort of settlement, those settlement negotiations can take anywhere between 7 and even 18 months to negotiate. And then if you were to just do a quick negotiation or go on a payment plan, those payment plans, I recently had one hit my desk. It was a $26,000 tax debt at $200 a month. I mean, it's going to take forever to pay off those IRS tax bills. And, you know, every year when you pay your taxes, if you get a refund, the IRS takes it to kind of pay that off. Number 4 And this is seriously probably one of the biggest challenges in America right now, and that's credit card debt. Credit card balances are at the highest levels they've ever been in the history. And with the raising interest rates, these credit card interest rates are increasing as well. So, when the rates were low, you could see rates in the 15 to 20% range. Now you're seeing rates as high as 30 and 40%. And that's just totally crazy to be paying on those high interest rate credit cards when you could possibly use a refinance to consolidate the debt and pay off the credit cards. Student loans are not bad when they're government or federal student loans. However, if they're private student loans are typically going to be higher in interest rate, and reducing that debt alone could seriously help out, because when we're taking out student loans for our college students, or you took out student loans because you wanted to finish a major, those debts add up fast, and they're big debts too. So you're using post-tax money to pay for pre-tax debt, and student loans are no bueno. Home improvement loans would be number 6. Home improvement loans could be something such as solar or vacuums. We saw that a lot. Security systems. It could be a roof that you had to get replaced, or windows and doors that you had to get replaced. I do a bunch of these home improvements because of my investment properties, and I will tell you some of these home improvement loans that I see come across my desk are extremely high. They have crazy terms on those, and a lot of times, because it's amortized for such a short period of time, the payments on those are extremely high, and it eats up a lot of your debt to income ratio. Number 7 would be medical debt. Medical debt and unexpected medical expenses can creep up on any one of us. I am a big advocate of getting a checkup every single year and maintaining, health as much as I can. I'll tell you, coming from a family that had a very ill parent, my dad did not always go to the doctor. He would just live through the pain because he didn't have medical insurance for a while. And in the end, medical debts kind of like came up and hit us really hard. As a child growing up, I'll never forget, when my dad got diagnosed with kidney failure, renal failure, dialysis, all these times and situations, I can really recall where I was at that time. And, growing up in a first generation immigrant family, and seeing how hard my mom had to save up $200 a month back in the late 70s, early 80s, to save up all this money to potentially buy a house, just to see all of that disappear because of medical debts, was something that I take very seriously. And if I would have had this type of knowledge and was armed with this type of knowledge when I was a younger child, things could have been different. Number 8, business loans. Business loans are huge, right? Because the average small business, the percentages of a business succeeding versus it not succeeding are very high. With businesses, a lot of people that want to get into entrepreneurship cannot handle the cash flow, or the low cash flow that comes with being self-employed, or the fluctuating income. And if you took out a business loan, typically those are going to be higher interest rates. And as the business becomes more established and financially secure, refinancing can definitely offer better terms for you on your business loan. Number 9, I would say, are personal loans. Personal loans are just loans that are not secure. You're just signing up for the loan based on your qualification of credit. And with those, because they're letting you borrow a large lump sum of money without any type of collateral, those typically come with much higher interest rates. And then I would say number 10, and we're seeing this a lot, people that qualified for homes while times are really good, right? They may have taken out non-conforming loans or hard money loans, or just in general high interest rate mortgage. So maybe you bought the house when your credit score was right in the 500s, and with that, you got a way higher interest rate. So maybe you've fixed some things, you've had your credit worked on, and now you're in the 700s on the credit score. This would be a great time. Now that we've talked about these 10 types of loans, why would you want to refinance? Obviously, if you could get a lower rate. A lower rate is typically going to lead to a way better payment. So I recently quoted a mortgage, and at the current interest rates, which were, let's just say 7s, right? For it to drop 2% into the fives on a $500,000 loan, $500,000 loan, would have saved this person close to $500 a month on their mortgage. So that is lower rate equals lower payment, and that's definitely a good way to think about refinancing. The second thing is I would look at your current mortgage, right? Look at the current mortgage, and let's just say that interest rate is 4%, okay? And that's at $200,000. If you had $100,000 in debt and you were to go out and get a personal loan or a home equity line, let's just say the interest rates are at 12%, okay? You're gonna blend those two rates together and you're gonna see what the blended payment and the blended rate would be. And if you were to then look at doing a straight refinance of the entire debt, what would that kind of look like on your payment and your blended rate? And at that point, you can kind of make that determination as to, hey, is this consolidation going to be worth it for me? So if I can buy in the first and second mortgage and eliminate all of the payments, including the current mortgage, and just have one mortgage payment, will that benefit me? If that answer is yes, then yes, I would definitely look into refinancing. Another reason to refinance is if you have an ARM rate, which is an adjustable rate mortgage. When rates are going down, adjustable rate mortgages are great. While the rates are going down, you're feasting on the benefits of the note rate or the LIBOR or whatever it is that the ARM mortgage is adjusting off of. And at that time, the rates are great. However, when the rates start going up in a rising rate environment, those ARMs tend to adjust plus whatever the note rate is at that time. So if you have an opportunity to fix it so that you don't have to worry about the mortgage roller coaster of your rates going up and down, then that's a great reason to refinance. Shorter terms, 100%, I would look at consolidating to a shorter term if you don't have to go out and use any more of your debt to income ratio to purchase additional properties. Taking cash out would be a good reason, and whenever you pay off one of these high interest rates loans, it is considered a cash out. So taking that cash out to cover home improvements, because if you don't put the home improvements in your house and your house is only worth $300,000 versus taking $20,000 out and then your house is going to be worth $350,000, just think about it. To gain that $30,000 equity to live in a house that is more suitable to your needs and to enjoy it before you have to sell it, 100% is a great idea. And then removing PMI and eliminating debt. To remove PMI is huge, especially when you bought the house with less than 20% down. So you are paying for PMI, which is private mortgage insurance or mortgage insurance premium. If you are able to remove the PMI, or MIP, depending on how much savings it is, it may or may not be worth it. When considering a refinance of any of these debts, it is really, really essential to kind of weigh the benefits against the costs. See what the cost is, see what the cost savings is, and divide it by the amount of months it'll take. Because some loans, such as the federal student loans, might come as a benefit that you'd kind of lose if you were to refinance. And there will be some fees and costs that are associated with refinancing. So always do the math. Make sure you're shopping for your loan. Make sure you're shopping with retail as well as wholesale so that you can see what the differences are. And on average, going wholesale is going to save you between $8,000 and $10,000, and that's based on 2022 HMDA data that was released by Housing Wire. But if you have any questions or concerns to see what the best move is for you, feel free to reach out. My name is 𝐸𝐫𝐧'𝐭. I can be reached at 757-478-8493, and I'm just saying, give me a call.